You ever look at one of those huge global companies and just wonder how it all fits together? I mean, how do you even begin to understand a business that seems to be doing 100 different things at once? Well, in this explainer, we're going to find the key that unlocks their internal blueprint.
Seriously, think about it. You've got these massive conglomerates that make everything from jet engines to medical scanners. And when you look at their big annual report, all you see is one giant number for revenue and one giant number for profit. How in the world are you supposed to know which part of that business is actually thriving and which part might be in trouble?
And this image right here, it just nails the problem perfectly. Those consolidated financial statements, the ones everybody looks at, they're basically a sealed box. You know there's a whole story happening inside, but from the outside you can't see any of the moving parts. You're completely in the dark.
But what if there was a way to pry that box open? What if companies were actually required to hand us a map, a blueprint, that shows us exactly how they see their own business from the inside? Well, guess what? There is.
It all comes down to an international accounting standard called IFRS 8, and its whole purpose is incredibly powerful. It forces public companies to report financial info for the different pieces of their business. It basically makes them pull back the curtain and show us what's going on. It's a total game changer for transparency.
And here's the magic trick, the principle that makes this whole thing so special. We get to see the business through the eyes of management. This isn't some random breakdown somebody made up. No, the whole point of IFRS 8 is for us to see the company exactly how its top execs see it when they're making their biggest decisions.
So if we're going to see the business through their eyes, we have to ask the obvious first question. Who are they? Who exactly is management in this situation? Let's break it down. The official term the standard uses is the Chief Operating Decision Maker, or CODM for short. Now, what's really important to get here is that this isn't always a job title like CEO. It's a function. It's whoever or whatever group is actually in charge of deciding where the money goes and judging how each part of the business is doing. Let's make this real for a second. Take a company like Roche. If you dig into their financial statements, they tell you straight up who their CODM is. And it's not one single person. It's their whole corporate executive committee. That's the group that's looking at all the divisions and making the big strategic calls.
And this is basically how they see the world. The CODM at the top isn't sweating the small stuff, like the sales of one specific type of sneaker. Nope. They're looking at the big picture, these larger buckets, clothing, accessories, sporting goods. These are the divisions they use to run the entire company.
Okay, so we've figured out who is looking at the business, the CODM. So now, what exactly are they looking at? What makes one of those divisions an actual division? Well, in the world of IFRS 8, we call these operating segments. And it's not just a vibe or a gut feeling. For a piece of the business to be officially called an operating segment, it has to pass a very clear three-part test.
So what's this formal test? It's actually pretty simple. You just have to answer yes to 3 questions. 1, does it actually do business? Earn revenues and have expenses. 2, do the top dogs, the CODM, regularly review its performance? That's our direct link to management's eyes. And 3, is there separate financial data available for it? If you can say yes to all 3, boom, you've got yourself an operating segment.
But hang on, we're not done yet. There's one more hurdle. Just because something is an operating segment doesn't mean it automatically gets its own special section in the annual report. It also has to be, big enough to matter.
The whole idea here is to keep these reports useful and not just bury us in mountains of data. We only want to see the divisions that are actually moving the needle for the company. And to figure that out, we use a simple numbers-based test. It's called the 10% significance test. And an operating segment only has to pass one of these 3 little tests to be important enough to be reported. Is its revenue more than 10% of the total? Or is its profit more than 10%? Or are its assets more than 10%? The bar is pretty low, really. If a division is a major player in any one of these areas, we get to see its numbers.
Okay, check this out. In this example, the retail segment is obviously a beast. It crushes the 10% test on all 3 measures. But look at the transport segment. Its revenue and assets are pretty small, but its profit is big enough that it still makes the cut. See? Just passing one of those tests is all it takes to get its own spotlight in the final report.
And finally, there's one last little safety net to make sure companies aren't hiding too much. It's the 75% rule. Basically, all those big segments that get reported separately, when you add up their revenue, it has to be at least 75% of the company's total sales to the outside world. It just ensures that the report is actually showing us most of the business.
All right, we've gone through the whole process, who the decision maker is, what a segment is, and how to know if it's important enough. But let's get to the real question. What does any of this matter? What's the big payoff for you?
This flowchart sums it all up beautifully. It's this logical, step-by-step process that takes us from deep inside the company's management structure all the way out to what we see in the final report. And what we get at the end is this incredibly clear, powerful view of what's really driving the business.
And this is why it's so incredibly useful. Instead of just one big blurry number, you can actually see the star performers and maybe the divisions that are lagging behind. You can see which parts of the business are growing like crazy and where the company is putting its money for the future. You could even understand the risks better, because a problem in one division might not even affect the others. It's like going from seeing a fuzzy silhouette of a company to having its detailed architectural blueprint right in your hands.
So there you have it. The sealed box is wide open. You now have the key and you know how to read the blueprint. So the only question left is, which company are you going to investigate first? Go on, pull up an annual report for a company you're interested in, find that segment information note, and see for yourself what's really going on under the hood.